News of the war, which people thought, oh, you buy that. No, you don't. You don't buy war news in the monetary metals. Suckers come in and buy it, in which case they're vulnerable to get kicked in the shin. And sure enough, they did. If you bought in the rally early this week, it was up to 96, I think. They bagged them. Now we're trading 83, 84. Gold went back to its high effectively. Now, that's not the way gold behaves if it's topping. But if you take that ratio between the lows of that 50-year range and the high, that's a tenfold range. That would project silver like 250 to 500 just to get even with its real dollar value. But you don't go up and make double tops. That's not the way the monetary metals have ever peaked or bottom. They go through it. They're setting up a triple top breakout. Now, silver's the laggard. We suspect by the end of this month, you'll see much more evidence of that. By next month, probably new highs. If you push gold back up above that 5,300 again on a close, it won't stop this time. Silver will ramp. JPMorgan and Morgan Stanley projected gold reaching 9,200 or something.
I want to ask you about that, precious metals, both gold and silver. Last time we had you on, it was right before silver crashed significantly from about 120 to below 70 in a matter of days. Now things seem to have stabilized, and you've talked about how the correction is over. Can you expand on this?
Yeah. The silver drop, we expected one. We frankly didn't expect it to occur in late January. We thought maybe it'd be late February or March. We had a major, what you call a green light go on that informed us through our studies that when the spread of silver breaks out versus gold, meaning when you plot the relative performance of silver on a chart relative to an ounce of gold, divide silver into gold, express it as a percent, there was a technical level to break through that would indicate, oh, silver's breaking out. Silver's going to launch versus gold. That was the November close. Okay, that occurred. When this has occurred before, over the past 50 years, what's happened in the following couple quarters is an explosion in the net price of silver. While gold still goes up, silver goes up a lot more. And it usually gets its job done in a couple quarters. Well, start from November, meaning December's month one, okay, then month two. So we kind of thought maybe you get into month three or so, there's usually a midpoint stumble. This one was sharper than we had expected, but it doesn't do any damage to our long-term momentum trends of gold or silver.
When silver collapses that fast, the timing matters more than the drop itself. As Michael Oliver points out here, the key signal wasn't the crash from 120 to under 70. It was the silver to gold ratio breakout back in November. Historically, when that ratio breaks, silver tends to outperform gold dramatically over the following 2 quarters, and that pattern has repeated several times over the past 50 years. What many investors miss is that early corrections inside momentum breakouts often appear violent but rarely break the trend. Next, Michael Oliver discusses why that sudden January shock may actually strengthen the larger silver breakout.
Whatsoever. Yes, you did some short-term damage. And in fact, you said a couple days, you were right. That break was actually 1 day and a half. One day, the last day of January and into the first trading day of February, and then you made your low. Since then, silver has gelled, and we're now 20 bucks off that low or so, or 18 or so off that low. And we're still well below the high. But gold, interestingly, though silver's still been outperforming gold even since November, went back up and had a close last week, I think it was, at 53.11 on the front month contract, which would be the April future right now. If you go back and look to January, not the high trade, admittedly that got up to 5,600, but the high close on a daily basis was 53.40. So effectively, we came back up to it, to the high on a closing basis daily, and basically matched it in gold. And then with that news of the war, which people thought, oh, you buy that. No, you don't. You don't buy war news in the monetary metals. Suckers come in and buy it, in which case they're vulnerable to get kicked in the shin. And sure enough, they did. If you bought gold in the rally early this week, it was up to 96, I think. They bagged them. Okay. Now we're trading 83, 84. Okay. But gold went back to its high effectively.
Markets often punish the crowd exactly when headlines feel most convincing. As Michael Oliver points out here, the entire silver crash actually lasted barely a day and a half, something most media coverage never emphasized. That matters because fast collapses inside strong trends often represent liquidity events, not structural breakdowns. Meanwhile, gold quietly climbed back near its prior closing highs around 5,300 even after geopolitical headlines faded, exposing how many traders simply chase narratives like buy gold during war. The real signal is resilience after panic selling, not the panic itself. Next, Michael Oliver talks about why gold revisiting its highs may signal something far stronger than a temporary rally.
Now, that's not the way gold behaves if it's topping. Whenever gold has made a major top or major bear low, 2011 high, 2015 low, it's isolated. You don't come back to that low or come back to that high. You may try to, but you never do. Gold went back up and basically matched from the daily close, the peak close of January. And then when you look at the miners, heck, they went back to their highs and even marginally nipped them out. That is, again, a sign that the air is not so thin up here that it's a top. In other words, you get up there and you fail, and then that's it. This time we go all the way back up to the highs again in the miners. Yeah, they pulled back since, but you don't go up and make double tops. That's not the way the monetary metals have ever peaked or bottomed with double tops. They go through it. It's setting up a triple top breakout. Now, silver's the laggard right now, but you got to look at the mama metal and the miners, and they're saying, hey, this is not as weak looking as you think it is. Anyway, that's our view right now, is that the metals are basing. We suspect by the end of this month, you'll see much more evidence of that. And by next month, probably new highs.
Most investors fear double tops, but the deeper signal may be something else entirely. As Michael Oliver points out here, gold returning to its previous highs actually contradicts the normal behavior of major market peaks. Historically, true tops, like the 2011 gold high, tend to be isolated events that markets fail to revisit. The fact that gold miners are also retesting or slightly exceeding their highs suggests strong underlying breadth inside the precious metals sector. That combination often appears before breakouts rather than collapses. If the metals complex pushes through resistance again, the narrative could shift very quickly. Next, Michael Oliver unravels why silver's lagging position may actually be the most bullish signal of all.
It has been quite exciting tracking this with you. You've been right every step of the way, which is I was shocked originally when you said silver should go to 60 to 70 within months when we were at about 30, and I was shocked even more when you said 1 to 200. But you've just been right every step of the way here. Now what you're saying is that you're not offering buy signals for anybody at the moment, given how much silver has run, but you do still see that the most undervalued or the greatest potential gain is in the silver miners.
Well, I mean, that's like, that's hardly what you call a free market point of view. That means the money unit's going to be destroyed by the government just to protect their paper, okay, which doesn't ultimately work. But ultimately, it does do something. It drives up real money, gold and silver. If you think about this another way too, silver was capped for 50 years at $50, with lows down around $4 or $5. Okay, so dimensionality there of $45. If you take that dimension and add it to the high, which is 50, you come up with a swing target of 95. If you go back and you'll notice on the way up to 120, there was a fighting effort in mid-90s. Some people said, hey, we've reached the swing objective. And they tried to top it and it didn't work.
The real story here isn't silver's price. It's the slow erosion of the currency measuring it. As Michael Oliver points out here, the broader force behind precious metals isn't simply supply and demand, but decades of monetary debasement. For nearly 50 years, silver was capped around $50 while global money supply expanded dramatically, especially after the 2008 crisis, and the massive liquidity injections following 2020. When long ranges finally break, markets often move much farther than expected. That's why mining stocks sometimes offer more leverage than the metal itself. Next, Michael Oliver discusses how decades of suppressed price ranges could translate into far larger upside targets.
Blew up to 120, okay? So meaning that didn't work. But if you take that ratio between the lows of that 50-year range and the high, that's a tenfold range in dimensionality. Tenfold times 50 is what, okay? You get the point. Also, if you factor in the decay of the money unit, M2, how much has it increased since 1980? You can do your own homework on this. Or since 2011 even, when we were at $50 the second time. That would project silver like 250 to 500 just to get even with its real dollar value. And also when you look at things like copper and lead, they had a range like silver had for decades. Silver stayed in its range up till just recently. They broke out in 2006, 2005 for copper and 2007 for lead. And what did they do in the couple quarters after that? Quadrupled in price and then lived in a new reality. How come silver wasn't able to do that? Gold made new highs each time it made a bull move. Eightfold gain, constantly blowing out the prior high, but silver wasn't allowed to. Well, whoever tried to restrain that didn't succeed. Okay. And so there's still chatter about, oh, golly, they're manipulating the market. Yeah, they may be, but are they winning? No. Silver's not $35. It's not 50.
For decades, silver looked stagnant, but that stagnation may have been artificial stability, masking a bigger shift. As Michael Oliver points out here, the metal spent roughly 50 years trapped under $50 while global money supply expanded dramatically, particularly after the 2008 financial crisis and the pandemic stimulus wave of 2020 to 2021. Historically, when long commodity ranges break, prices can multiply rapidly, just as copper and lead did after their early 2000s breakouts. The real question isn't whether silver can move higher. It's how far markets must reprice after decades of monetary expansion. Next, Michael Oliver shows why those historical range breakouts could imply dramatically higher silver valuations ahead.
They lost. And, they're going to be trampled if they try to get in the way, especially if you go back. If you push gold back up above that 5,300 again on a close, it won't stop this time. Silver will ramp. And that's when you'll see the bigger portion of the move in silver than what we saw from November through January. Seemed like a lot, but on a ratio basis, hardly even reflected the dimension of the prior range. So anyway, I think we're sitting on dynamite there, and I think it'll unfold largely by early to midsummer.
No, the difference in your analysis that I've seen as we've continued to talk to you here is you're obviously looking at momentum rather than just price. And a lot of people analyzing the charts throughout this run for silver have been calling tops here and there and saying, oh, it's way overbought. Look at the RSI. One of the things that I just find really interesting is obviously you've been accurate this whole time.
Here's the quiet tension building beneath the metals market. Momentum is rising, while skepticism still dominates commentary. As Michael Oliver points out here, a decisive goal close above 5,300 could trigger a second phase of the silver rally, potentially far larger than the November-January surge. That matters because strong commodity trends often accelerate after early consolidation phases, especially when analysts repeatedly call premature tops using indicators like RSI. Markets can stay overbought far longer than models assume. If momentum continues building into summer, the next move could catch many investors off guard. Next, Michael Oliver discusses why momentum analysis may reveal signals that traditional technical indicators miss.
But also that now certain mainstream voices are seeming to echo what you're saying. For example, at Bank of America, one of their analysts is projecting $130 to around $300 silver by the end of 2026, which is pretty close. I know you're more bullish than that, but what is your take on it? It seems like even in the mainstream now, the extreme bullishness of silver can be seen.
Some of the biggies, yeah. I think JPMorgan and also another major bank, I'm not sure, may have been Morgan Stanley, projected gold reaching a level we've mentioned a year or so ago. That's 8,000 plus. And the rationale for that, and I'll repeat it, I've probably said it on your show before, it is nothing but a replication of the two prior bull moves in gold. They were both eightfold dimension. Bear low, bull high, bear low to bull high, 8 times gain from the low. Well, our low was what? 1,050. You do the math. Okay. Now suddenly JP Morgan comes up with a number of 9,200 or something as a target based on some fundamental analysis they did. Fine. But it's interesting to hear that now, a year after we've been saying, hey, that's no big deal to even go 8,000. We've done it twice before. Eightfold move.
Wall Street usually dismisses big upside targets until the market already moves halfway there. As Michael Oliver points out here, institutions like Bank of America and JPMorgan are now floating silver projections as high as $300 and gold near $9,000, numbers that would have sounded extreme only a year ago. Historically, gold's last 2 bull cycles produced roughly 8-fold advances from their lows, which is the same structural pattern Oliver is highlighting. What often goes unsaid is that banks rarely publish aggressive targets until positioning has already begun shifting internally. For investors, the timing matters. Next, Michael Oliver discusses why repeating those historical expansion cycles could reshape expectations for the entire precious metals market.
And consider the background that we're living in, the fundamentals that are underway, government debt problems. That wasn't the issue in 2007 to 9. It was mortgages. Now we got government debt being questionable, okay? Long-term debt. Whoa. I mean, that's a major asset category. It's bigger than the stock market. It used to be an alternative to the stock market. If the stock market was in trouble, you could buy bonds. In fact, that worked. 2007 to 9, stock market imploded, bonds went up. So did gold during that time. 2000 to 2002, stock market got cut in half. NASDAQ dropped 80%. Gold went up during that time. Bonds went up during that time. Right now, bonds are suddenly, not so sure they're going up. Yields might, but the prices isn't. So what does that leave you with? One alternative. And it's never the case in history that when you have an asset class implosion like that everything goes down. Yeah, there might be a moment here or there where gold goes down with the stock market, but basically its trend will be opposite a stock market bear.
For decades, investors assumed bonds would always cushion stock market downturns, but that assumption may now be breaking. As Michael Oliver points out here, today's macro environment is fundamentally different from the 2008 crisis because the risk is no longer mortgages, it's sovereign debt itself. Government bond markets are enormous, often larger than equities, and when yields rise, the price of those bonds falls, eliminating the traditional safe haven rotation. That creates a rare vacuum in global portfolios, where trillions of dollars must find a new home. Historically, when one asset class fails, another absorbs the flow. Next, Michael Oliver talks about why precious metals could become that destination if bonds stop acting as protection.
And so if all of a sudden you don't even have T-bonds as an alternative, wow, you have a vacuum. And anybody who is continually calling for tops in gold and silver, it's a continual process. And every time they do, and I'd have never seen a bull market top in gold where everybody screamed it was a top. Okay, in fact, in 2012, when we put out we called the top in the gold market, we said it's over. We hit 1920, and we dropped into January of 2012, and we said that was it. It's over. Only 2 months off the high or so. Over the next year, gold went sideways, but never got back to the high. And we had complaining subscribers. We had to write a report called Open Letter to the Gold Bulls, okay? Explaining to them, sorry, we know you love it. It's good in the long term, but it's going down. And we gave them the technical reason. Right now, we have 0 technical long-term reasons to assume gold has made a top or silver.
When everyone confidently calls a market top, history suggests the real top is usually far away. As Michael Oliver points out here, the last major gold peak in 2011 to 2012 was accompanied by very clear technical signals, including a failure to reclaim the highs around 1,920 after months of sideways trading. Today the charts simply don't show those same structural breakdowns, even though many commentators insist the rally is finished. That disconnect between sentiment and market structure often appears during the middle phases of long bull cycles. For investors, that means the biggest risk may actually be exiting too early. Next, Michael Oliver unravels why traditional technical rules may be failing in this particular metals rally.
So it's a totally different situation, yet everybody's crying, it's over. I love it.
Do you anticipate that the, normal technical analysis that may project silver going back to 54, right, or going back to that level just because that's where it broke out of, right? Do you anticipate that analysis that so many people are doing just isn't going to work this time because of the circumstances, right?
They've been saying it all the way up, not with silver, but with gold. Every time gold makes a high, a prominent high, it usually will plateau for quite a few months. Look, go back to April, May, June, July. It took like 5 months for it to get up out of that range it was at. And every time we do, everybody who calls for a correction thinks it's going to go back to the high end of the prior range. And if you go back and look, it doesn't do that. It hasn't done that. It's had drops, but it never goes back to the orthodox level where people say, that was old resistance, it's now support.
Sometimes the biggest signal in markets is when textbook rules simply stop working. As Michael Oliver points out here, traditional chart logic says a breakout should eventually retest old resistance as support. Yet gold hasn't returned to those levels despite months of predictions. Between April and July, the metal consolidated for nearly 5 months before pushing higher, and every expected pullback to prior resistance never materialized. That kind of behavior often appears in unusually strong momentum cycles, where demand overwhelms technical expectations. When markets refuse to revisit old levels, it usually means underlying buyers remain aggressive. Next, Michael Oliver discusses why silver could behave the same way if this momentum continues building.
So they're using a rationale that isn't working. And we have the same thing going on right now. Silver's going to go back to 50. That's the top. Well, anything could happen, I guess. But our work says no. It says you better be prepared, because if you don't break this market real soon, further than what we saw on the first trading day of February, basically you could circle it on all the miners, on gold, on silver, just circle that. And look where you are now compared to that. You better go take that low out soon, or you better think a different way. This is not a normal bull market. So the orthodoxies of, it's overbought. Yeah, in a normal situation, yes, it is. But that doesn't mean this is a normal situation. And therefore you can get overbought and stay overbought longer than you might think, in which case you missed the move. Okay. So anyway, that's our assessment right now.
Markets rarely reward investors who wait for the perfect pullback everyone is predicting. As Michael Oliver points out here, the February drop in silver should have triggered a deeper collapse if the trend were truly weak, yet prices stabilize quickly above that low. That kind of resilience often signals consolidation rather than distribution, especially when mining stocks and gold remain structurally strong. What many analysts overlook is that powerful trends can stay overbought for months while skeptics keep calling the top. Waiting for textbook corrections in those environments often means missing the entire cycle. Next, Michael Oliver shows why momentum trends can remain stretched far longer than conventional indicators suggest.
We think that we're not issuing any long-term buys, and the reason is we issued 3 over the last year or so. One was in April, May, June of 2025. Gold was coming up back toward 35 again. We issued one in early 24 when it was coming up through 25 to 26. That was a major buy for us. We knew it was going to blow out the 25 level, which it finally did, and it zoomed into the 30s. Then it congested for a whole year with tops at 35. We had a pullback into April last year. Started moving back up. When we started to move back toward those old dual highs at 35 plus, we said, this time it's different. It's going to blow through. It's going to accelerate. That was our second major buy. Our third and final major buy, based on long-term metrics, was the November close. That's when silver broke out versus gold. We're not going to offer any more buys. In other words, if you're buying now or later, you're on your own. Yes, you're probably going to make money, but it's not an optimal point of entry. And that's what we try to offer.
Timing often matters more than conviction in long market cycles. As Michael Oliver points out here, the biggest opportunities in this rally actually appeared much earlier, during the 2024 breakout through the mid-20s, and again when gold approached the $35 resistance zone in 2025. Those signals came before the crowd recognized the move, which is usually when risk-reward is most favorable. Once momentum becomes obvious, late entries can still work, but carry higher volatility and smaller margins for error. That's a lesson many investors forget during strong bull markets.